Hi guys, today we're going to talk about consolidation patterns. So right now I'm looking at Roblox. Roblox had an IPO since early 2022, but if you look at Roblox, Roblox has been in a consolidation form. What is a consolidation? Well, consolidation happens when you have a top and a bottom, but the price is doing this, right? It's not able to break above that top and it's not able to break below the top. So it's consolidating within the range. What does this tell to investors and traders? That clearly the market is not having a sentiment to push the price further upward towards an uptrend, and neither is it still deciding to push the price downward, right? It's still deciding which direction it should go. What's interesting about these patterns too is that this is where a lot of market makers like to play. A lot of people who have liquidity. What they do is that, let's say for a bottom scenario, sometimes when the price breaks below it, a lot of investors or traders think that this is an indication that the price is going to go down further because it's a breakout. What happens is that these bigger liquidity players push the price down intentionally so they can make people sell, and then these buyers that buy make those people who have sell orders to buy because they see, oh wait, it's starting to go up. No, let's actually remove these sell orders to buy it. And what that does is that pushes the price up further. What what this is indicating is that the people who have liquidity are controlling most of all the stock or whatever asset you're looking at. That way, when the price goes up again, maybe they have another false breakout, and then they trick traders. They do this so they can have more quantities of the asset by removing people out of the asset to take hold of those assets at attractable price levels. That way, when they feel confident enough that there's not enough people in the quantity and that they can control it, that those sellers or pessimism is out, then they can push the price upward or downward, whatever sentiment they want. Now, that doesn't mean that market makers are the absolute gods of the market, that they can control everything, right? It doesn't mean like that. It's actually counterintuitive when the market maker has full control, absolutely full control of the asset, because they have to pump it up completely. And if they pump it up completely and they put all their money, some emotional pattern can come in from retail traders and sell the price down, and they would lose a lot of money. So it's counterintuitive. So that's why they're strategic about it. And by the way, that's legal. They're required to do that. But out of market makers, that's not primarily what I want to discuss today. I want to discuss the attractive levels that you can use to enter in consolidation patterns. So if we look at Roblox here, you can see that Roblox has, gone up, gone down, gone up right to here. But once it gone up, it reversed and came back down. So this shows that prices are respecting this sort of level, which means the next time the price goes to this price level, it's likely that it's going to repeat the same pattern and come back down, right? Maybe it might break above it, but do a false breakout and come back down. Same is said for the low, right? This could be the low. If the price comes back to this low or comes close to it, it's likely to rebound as it did right here. So these are the sort of entries you'd be looking for. They're sort of like ranges of tops and bottoms. You never want to trade in a consolidation right at the mid level, which would be here, like right between the top and high, because obviously you know that there's a consolidation of first price where prices want to go up to the resistance, which is this highest top, and want to come down to this other resistance. Okay, so in a consolidation, they ideally have to be the same highs and the same lows. They don't have to be the exact same highs, neither the same lows, but they have to be close to it. You can see that this low is a little lower than this low. This low kind of looks a little bit lower than this one, but they're overall not going higher highs, higher lows, higher highs. Like, you don't see this. You see them really staying within a range. Well, that's what we traders like to see, because if prices come up towards the high, we could have a probability that if there's resistance and that there's a lot of bearish indication at this context, then we could prepare a short or sell order to bet that the price can go down. And once it goes down, our profit target would ideally be at the bottom level, because when it goes to the bottom level, it's likely to rebound. So it would be foolish to have the profit target here if it's hard for the price to come down. It's actually easier for the price to come here. So it's in terms of risk to reward. What's important is to risk one and to make two. Okay. So at this bottom level, if you reach the profit, you get your profit. And if there's another entry here, then you enter with the bullish order, right? And then you just kind of repeat the patterns. You repeat the patterns based on the rebounds. That's what you do in consolidation forms, right? And look at the entries here that you could do. This is one. This is another, right? Then over here, it didn't went close to it, right? So you wouldn't necessarily trade that part. But right over here, it got pretty close to it. And plus, it doesn't have to be this low. What's important within a range is to see where prices have respecting the most consistently. So it doesn't mean that if the highest was over here, then if the price starts to move like this, then if the low was right here, then you kind of want to count this level now because the prices are respecting once and twice to this level. And then once the price hits this point, it's 1 and 2. So you want to have really 2 points. That's what I call it. Once you have 2 points, then you can kind of trace your level towards this one and trade with this other range, because this shows that prices are respecting more this range than this top or low. It doesn't mean that they won't respect this, but it's more likely with a probability that they'll just stay within this range rather than completely this top range, right? And also with consolidations, you don't have to always actually trade, the rebounds where it's up here or down. The thing about consolidations, remember, is that they're indecisions. So ultimately, they're going to make a decision whether they want the price to come up or come down. And once they do, when they break, let's say, above this level, what's important, very important here, is to see the history of this consolidation. If it's formed with the proper patterns, which are lower volume, because a lot of market makers enter here, a lot of lower volume, and not many people, sure of where the price can go, that's more likely where the price will actually go to a direction, because that's what a lot of liquidity players like to see. But additionally, is to see technical patterns where they're hitting most support. So once they break out of this and they show a solid, bullish candle, then you can bet on the upside, and that could be another bullish trade. Same instead of the price comes down and it shows a bearish form on the candlesticks or other sorts of indicators as well, then you can bet on the downside with a short. Okay, so those are for consolidation patterns. Now, talking about the context of the market today is actually going down. Yeah, it's going down. Yesterday and for this week, I said that it's kind of a 50-50 in total. If the price does indeed to come down, it's not likely to go to this longer term moving average, but we can't also rule that out because anything is possible, but it just has a lower probability compared to the price rebounding to one of these averages. That's for the S&P. Looking at the Dow Jones is also going down, not as much to the S&P, and it's actually staying within the 20 moving average. But this doesn't show really clear indication where the price wants to move, whether it wants to move down or upward, because there isn't a clear signification of the price respecting something or indicators to push it somewhere. It's just staying here, and there's yet more to come. For the NASDAQ shows now a clear signal. This looks like it wants to meet towards the 40 or the 50 moving average. So it is possible that the price can go down a little bit more. But I do have the same, maybe a little bit less, because it does, the longer term moving averages are a bit closer to the price compared to the S&P. So it is possible that the NASDAQ can go down a bit more. Just have that in context, that could happen. But it could also happen that the price respects here. So you could prepare a bullish order nonetheless, and this could give great opportunities for companies that you've been waiting to buy inside the NASDAQ. Okay, so that's for the context of the market today. The S&P looks like it's on the 20 moving average. It's possible that it can respect it and continue to go upward, because remember that this does not show that prices will go down indefinitely, because recall that prices don't go completely up in a straight line. They have red candles and green candles. So this is the same thing. This has no clear indication that the price can come down. It's just fluctuating. That's what's happening. That's it for today for the preview of this lesson. If you want to learn more about other lessons, you can book a call with me down in the description. Take care, guys. I'll see you tomorrow.